Today we'll go over the closing process specifically for a service business. I'll cover this topic again for merchandisers in a later video. As I've already mentioned elsewhere, this video will serve as a good summary for everything discussed so far. Let's do a high-level summary first. The accounting cycle is the series of tasks performed by the accountants every month. Depending on your textbook, the cycle may consist of as few as 6 steps or as many as 10, depending on whether they are combined or separated. But the general process is as follows. First, we record journal entries and post them to the ledger throughout the month as the transactions occur. These transactions will be for activities like purchases and sales. Once we arrive at the end of the month, we then prepare the trial balance. This is a check to make sure that total debits equals total credits. If the two do not balance, we know we have an error that must be corrected before proceeding. Next, we record and post our adjusting journal entries. Remember, these are the activities that occurred internally within the company to reshuffle the accounting equation. Expensing prepaid assets like prepaid rent, accruing expenses or revenues, adjusting unearned revenues. These are all adjusting entries that must be recorded to ensure that our records are as accurate as possible as of the end of the period. Once the adjusting process is complete, we prepare another trial balance, commonly called the adjusted trial balance. Note that the previous trial balance is correspondingly referred to as the unadjusted trial balance. The purpose of this trial balance is the same as the first one. Verify that total debits equals total credits. If they don't balance, we know we have an error that must be rectified. Furthermore, if debits don't tie to credits on this trial balance, but they did on the previous one, we know that the error occurred somewhere in the adjusting process. If we neglected to build the unadjusted trial balance, we'd have no idea where that error occurred. It could have happened all the way back with the first journal entry in step 1. Building these trial balances offers a quick way to isolate where any mistakes may have occurred and hopefully quickly identify and correct them. Next, we build the financial statements, such as our income statement, the statement of owner's equity, the balance sheet, and eventually the statement of cash flows. After building our financial statements, we record and post our closing entries. These entries will move our revenues and expenses into our owner's equity. We'll talk more about these entries momentarily. Finally, we prepare and post our post-close trial balance. Just like the others, this trial balance verifies that total debits still equals total credits. And we repeat the cycle again next period. If these seem like a lot to remember, you only have to remember steps 1, 3, 5, and 6. After that, just remember that after recording and posting any journal entries, you do a trial balance to ensure that total debits equals total credits. For the purpose of this example, let's imagine we've already recorded and posted our journal entries as they occurred during the month. Oftentimes, our trial balances will be prepared by updating a single worksheet. Here we see the unadjusted trial balance presented in the center of this spreadsheet. We have all the accounts listed along the side, along with their respective debit and credit balances. At the very bottom, we can see that our total debits match our total credits. If this weren't the case, we know we'd have to identify and correct an error before proceeding. If they balance, that doesn't necessarily guarantee that we're free of errors. For instance, imagine that we debited equipment when we should have debited supplies in a particular entry. Debits would still equal credits, but we'd have a debit amount in the wrong account. That aside, since we balance, we can presume we're safe to proceed. Next, we prepare our adjusting entries. We already covered adjusting entries in our last lecture, but here they are again just to refresh your memory. Our supplies expense, our depreciation expense, our accruals for salaries payable, unearned revenues, and accounts receivable. I almost forgot, we also had prepaid insurance. No matter, the order of booking adjusting entries doesn't matter so long as we get them all. As previously stated, our accounting equation must always balance. We need to make one modification from the last time we saw this information at the very end of Lecture 3. Our original journal entries for Coats and Arms didn't include the advance payment of $900 from one of its clients. Remember, we debited cash and credited unearned revenue for $900, so we have to reflect that change. Cash's debit should be $900 higher, increasing total assets by that amount. Liabilities will include unearned revenues, increasing its total credit to $214,900. Next, we post our adjusting entries to our ledger accounts. Every journal entry we book gets posted to the general ledger. Our adjusting journal entry for supplies will decrease both our supplies asset and our net equity by $4,000. Next, we have our depreciation adjusting entry. So observe a new debit balance in a depreciation expense account and 3 new asset accounts, but with credit balances since these are contra assets. Next, we have our salaries expense. So the debit balance in salaries expense increases to $4,860, and we add another liability account with a credit balance of $1,260. Then we have our adjustment for unearned revenue. Recall that we earned $300 of that advance payment, so we'll debit unearned revenue and credit fees earned, both for $300. Finally, we have our accrued revenue. That was a large one, with a debit to AR for $25,000. And a credit to fees earned for the same amount. After all of our adjusting entries are posted, the equation is still balanced. We'll have a total net debit of $344,125 in assets, a credit of $216,160 in liabilities, and a net credit of $127,965 among our equity accounts. Once we've finished recording and posting our adjusting entries, we prepare our adjusted trial balance. At this point, we return to our worksheet and show the results of our adjusting entries. Starting with our adjustment for prepaid insurance, we put a debit in the appropriate column under adjustments and the adjusted balance updates. Do the same with a credit to prepaid insurance and see the adjusted balance of $2,300. From our supplies adjusting entries, we transfer our debit to supplies expense and our credit to supplies. You can observe the updated balance in the adjusted balance columns to the far right. After posting the amounts to our worksheet, the amounts in the adjusted balance columns will match the amounts in the general ledger, or our T accounts. Our depreciation adjusting entry puts a debit to depreciation expense, and a credit to our 3 accumulated depreciation accounts. Our accrual for unpaid salaries debits salaries expense and credits salaries payable. The adjustment for unearned revenue debits unearned revenue and credits fees earned. Finally, our accrual for the job we completed but haven't yet billed debits accounts receivable and credits fees earned. Combined with the previous credit of $300, the $500 credit brings that amount to $39,800. Since every journal entry has the same total of debits and credits, our adjusting entries will also have an equal sum of debits and credits. We then determine our adjusted balances for each of our accounts. For accounts that weren't impacted by our adjustments, like cash, the balance will remain the same. Of course, since our unadjusted balance had equal debits and credits, and our adjusting entries have equal debits and credits, our adjusted balances will also have equal debits and credits. Once we have our adjusted balances, these are the balances we will use to build our financial statements, just as I showed you 2 videos ago. Next, we build our financial statements. To review, first we build our income statement. We look at our worksheet or our adjusted trial balance, whichever we're using. Look at the revenues and expenses section, and we can build our income statement. List our revenues and sum them if we had more than one. List our expenses, sum them, and then we take the difference, which is our net income or our net loss. Next, we build our statement of owner's equity. Here we don't look at the trial balance. Instead, we look at the actual T accounts of owner's capital and owner's drawing. Since this is CNA's first year of operations, the beginning balance is 0. We made 2 journal entries for Thaddeus's contributions, the $85,000 of cash and the $16,000 for his automobile. The sum of these 2 amounts go on our contributions line for our additions. Next, we add in our net income or our net loss from our income statement. After that, we subtract out our drawings. You can pull the drawings from the T account, or you could get it from the trial balance. The debit balance in drawings only represents outflows for the current year, as opposed to the credit balance in owner's capital, which can represent both the inflows of capital as well as the beginning balance. That's why you could just take this amount from the trial balance. But I usually tell students to look at the T accounts to keep the process more simple. Sum the amounts up to get our net increase or decrease in owner's equity, and combine that with the beginning balance to get the year's ending owner's capital. Our balance sheet comes next. We'll start by looking back at our adjusted trial balance and copying over our current assets, those that will convert to cash or otherwise be used or consumed within a year. Next, we look at our plant, property, and equipment. We'll have land in this section, along with our depreciable assets. We want to be sure and pair each asset account with its respective accumulated depreciation account. Since the asset account carries a debit balance and its contra account carries a credit balance, the two will net against one another to provide each asset's net book value, or its unexpensed portion. After that comes our liabilities section. Just like our assets, we'll separate our liabilities into current and non-current, based upon when they'll be satisfied, within 1 year or beyond that time period. Lastly, we do the owner's equity section. Here, we take our ending owner's capital balance from our statement of owner's equity. When we sum our total assets and compare that amount to our total liabilities plus our total equity, we'll see that our accounting equation balances. Before we go any further, I'd like to call your attention to the time periods of our financial statements. Notice that the balance sheet is just for a particular point in time. In this case, as of December 31st, 2000Y5. In contrast, the income statement and the statement of owner's equity are each for 1 year periods. The balance sheet just shows how much resources, obligations, and equity a company has as of this date. The income statement, statement of owner's equity, and statement of cash flows show a company's increase or decrease in those balances over a period of time. Next, we record and post our closing entries. We're getting close to the end. Next, we'll prepare our closing journal entries. Before that, let's discuss temporary versus permanent accounts. Permanent accounts are those that keep their balances from 1 year to the next. Cash is a good example. Coats and Arms has $11,900 in cash as of December 31st. That money thankfully doesn't disappear once the year is over. Accounts receivable is another good example. The customers that still owe Coats and Arms $27,500 as of the end of the year will still owe CNA that money as of January 1st next year. Their debt isn't wiped out with the arrival of the new year. Same thing with accounts payable. Coats and Arms currently owes $24,000 to its vendors. With the arrival of the new year, CNA still owes that amount. Likewise, Coats and Arms will still own $60,000 worth of land and $160,000 worth of buildings with the arrival of the new year. They don't disappear. So to summarize, permanent accounts are the company's balance sheet accounts. Every account on the balance sheet is going to retain its balance in the following fiscal year. Our temporary accounts are those that are cleared out at the end of the year. These are our non-balance sheet accounts. So our income statement accounts, like revenues and expenses, as well as owner's drawings. These accounts are cleared out because they are just supposed to convey the results of the current year's activities. Here we see an application of our time period concept, which said we could divide a company's life into various time periods for reporting purposes. Revenues is a good example. If we never cleared out that amount, revenues would eventually grow to an astronomical number, and we'd have no idea if that money represented this year's earnings or any of the previous year's earnings. Our closing entries are just going to occur within our equity accounts. Specifically, we're going to move our balances from revenues, expenses, and owner's drawings into the owner's capital account. There are a few ways you can do this, but they all give the same result. One way involves using an income summary account. I haven't mentioned it before because this is the only time it's ever used, and it carries a zero balance for 99.9% of the year. Income summary is just a holding account for verifying that we've zeroed out all of our revenue and expense accounts before moving them into owner's capital. The first entry we'll book is to zero out fees earned by moving its balance into income summary. To do so, we'll book the following journal entry. The debit to fees earned moves that account balance to zero, and income summary now has the credit balance that was previously in fees earned. Next, we'll do the same thing with our expense accounts. Our expense accounts carry debit balances, so we'll book this entry. We'll credit each expense account for its balance, resulting in a zero balance. Income summary gets a debit equal to the sum of all of our expense account balances. The new debit in income summary nets against the previous credit we booked there, and we have a net credit balance of $29,165. You may recognize this number as our net income. Remember that net income is calculated on the income statement as the difference between revenues and expenses. After that last entry, such is our balance in the income summary account. It's the difference between our revenues and all of our expenses. Note that if Coats & Arms had a net loss, expenses would exceed revenues, and this account would carry a debit balance, not a credit balance. If after this step, this balance does not equal net income, or our net loss as the case may be, we know we likely have overlooked closing out a revenue or an expense account. Next, we'll move our balance from income summary to owner's capital with this entry. Income summary has a credit balance, so we'll debit it to move it to zero, and we'll put the corresponding credit in owner's capital. This brings our owner's capital account to a $130,165 credit balance. Finally, we'll move our drawings account balance into owner's capital. Here's our entry for that. Like expenses, drawings carries a debit balance, so we have to zero it out with a credit. And we debit owner's capital for the corresponding $2,000. Consequently, our final owner's capital balance drops to a $128,165 credit balance. This is the balance in owner's capital that will carry over into the new year. Our revenues and expenses, as well as our drawings, all carry zero balances. So when Coats & Arms books anything to those accounts during the next year, their balances will only convey that year's activities. Yet another quicker way to close out our temporary accounts is to move revenues and expenses directly to owner's capital without an income summary account. Under this method, our first entry would be as follows. We'd need to book a debit to revenues, or fees earned, to zero it out, as well as credits to each of our expense accounts to achieve the same effect. The problem with this journal entry so far is that it's out of balance. To make it balance, we need a credit equal to the difference of our revenues and our expenses, which would be our net income. We'll put this credit to our owner's capital account. The end result is the same as what we did on the previous slide. We cleared our revenue and expense balances to zero and credited owner's capital for our net income amount. Next, close out drawings to owner's capital just as we did before, and we arrive at our ending owner's capital balance to carry forward into the new year. Also note that our total equity didn't change. we had a total of $128,165 in net credits before our closing entry, and we now just have one account with a credit of that very amount. Once we've booked our closing entries, our owner's capital general ledger should reflect what we reported in the statement of owner's equity. We see our beginning balance of 0, again because this was Coats & Arms' first year of operations. We also see our credits for contributions of cash, equipment, and an automobile reflected as additions on the statement. Similarly, we see our credit for net income reflected as another addition. Finally, the debit for drawings is a reduction on the financial statement. Consequently, the ending balances will tie to the cent. Let's talk more about these closing entries. I'd like to re-illustrate what I just said with a separate, simpler example. Imagine we have the following balances in revenues, expenses, owner's drawings, and owner's capital. The general process we just saw was to first debit revenues and credit expenses for their respective balances, then plug the difference to owner's capital. The debit from revenues will reset that account to 0. The credit to expenses will do the same, and owner's capital will increase by an amount equal to the year's net income. We then close out drawings with a credit and debit its balance to owner's capital. We post to our ledger accounts, and owner's drawings returns to 0, and owner's capital arrives at an ending balance of $75,000. There are other ways you can close out these accounts, and depending on which text your course is using, you may see the entries performed in a different manner. Note that while the process may be slightly different, you'll always arrive at the same results. Allow me to show you one such alternative entry in the bottom left corner of the screen. I've included the previous closing entry in red in the top left so you can observe how this one is different, yet it yields the same result. Under this method, you could close out your revenues and expenses separately. Here, we debit revenues for its balance and credit owner's capital. Next, we credit expenses for its balance and debit owner's capital. Look at the result of posting these journal entries to their ledgers. The net effect of the debit and credit to owner's capital is a net credit of $60,000, the exact same amount as in our previous entry. In both instances, we credited owner's capital for the value of the year's net income. Then, we close out our drawings just as we did previously. When all is said and done, we have an ending credit balance of $75,000 in owner's capital, exactly as in the previous example. One more way you may see the closing entries booked, depending on your course, may involve the account I showed called the income summary. Again, I've included the previous style of closing entry for comparison in red in the bottom left corner. This method is almost identical to the previous one, save for the new account. We'll close out our revenues and our expenses individually, but we'll initially move their balances to the income summary account. In other words, debit revenues and credit income summary for $100,000, bringing the revenue account balance to 0, and income summary now has a $100,000 credit balance. We'll then debit income summary and credit expenses for $40, bringing expenses to 0, and income summary to a $60,000 credit balance. At this point, income summary has a credit balance equal to the company's net income, meaning that no revenue or expense account has been overlooked. So we can close our income summary to owner's capital. Close out drawings just as we've done in the previous examples, and owner's capital will have an ending balance equal to the year-end balance on the statement of owner's equity. Finally, we prepare our post-close trial balance. The post-close trial balance just verifies that our temporary accounts are zeroed out. Our permanent accounts retain their balances from the previous trial balance. Our revenues, expenses, and drawings are empty, and owner's capital has the updated balance from its ledger after the previous closing entries. Of course, total debits still equals total credits, and we're ready to proceed into the next fiscal year. That concludes this video on the closing process. My next videos will go over purchases and sales of merchandise inventory. Please note that I'll have two sets of videos, one for the gross method and another for the net method. Please be sure to view the videos that align with the method taught in your own accounting course. As usual, thank you for watching. If my videos are helping you and you want to return the favor, you can leave a thumbs up. If you have any questions or suggestions for how I can improve, leave them in the comments below. If you really want to help, temporarily subscribe to my channel. Not forever, just for however long you're taking your accounting course or courses. Finally, please share my videos with your fellow classmates and even your professor. I'd like my videos to help as many students as possible, and I wouldn't mind getting some input from contemporaries. Thank you once again, and I'll see you in the next one.